Joining us with his take now on all of this is Goldman Sachs co-head of Asia Macro Research, Asia Pacific Chief Equity Strategist Timothy Mo. Nice to have you here.
Hi, David.
I don't know if you got a chance to listen to Mr. Navarro as
Actually,
well.
I did with great interest.
Yeah. Anything strike you?
I guess a number of things. One, it certainly is our view, which I was very happy to hear, validated that this at least gives a window for markets and is at least in the short term constructive. We put a piece out, just a quick one yesterday, and I think that relative to what markets' expectations were going into the G20, there was a mild upside surprise in terms of getting more negotiating space, not having a 10% tariff put on that so-called list 4, and then the mild concessions on Huawei, which you obviously were discussing. So the key point I'd like to make from an investment standpoint is that we have a market-based indicator of how optimistic or pessimistic the market is with regard to trade. We updated it daily, and going into the G20, it was suggesting there's only an 18% chance that the market was pricing of a trade deal. Moreover, investor positioning is quite light right now. So with people conservatively positioned going into the deal and into the negotiation and a somewhat better outcome than the baseline, that suggests to us that at least in the near term that markets could have a bit of an upside move, which indeed we've seen both in the A shares as well as yesterday overnight with the H shares in Hong Kong.
And where, today I think it was, Vice Premier Lee talked about further easing of ownership limits in more sectors, reducing negative investment lists for foreigners.
Yeah.
That was at World Economic Forum in Dalian. Is that a positive in Europe?
At the margin, yes. Maybe if I could just step back and just sort of very quickly summarize what we think is the bigger picture, because there's so many different moving parts, I think it's helpful to contextualize things. Our bottom line here is we think we're in an environment where there's what, unfortunately, you can call a high noise to signal ratio. So our baseline is we're moderately constructive because we think that markets are decently priced. China in particular is inexpensively priced. Investor positioning is light, and we've got a severe pivot by the Fed, as we know, in terms of easier monetary policy, and certainly that's where the market's pricing, and that's percolated out globally. So globally, we're out of QT back to pretty much QE, and that's very supportive for asset prices. The problems, the challenges are, number one, that you've got this uncertainty about trade. Okay, in the near term, we've got some positive news, but there's going to be some twos and fro's on this, and there is potential downside. And as you and Sarah were discussing, if the list 4 tariffs go into effect, that clearly will have downside for growth and for earnings. I can go into more detail on that. We've done some detailed work analyzing some scenarios, but there will be some downside to some extent. Moreover, there's valuation risk around that in terms of uncertainty and so forth. So that's the first big thing. Second thing is there's clearly a coordinated slowdown in global growth. So the image we have is like sort of two mountain goats that are butting heads. You've got sort of the concerns about trade and slower growth. You've got the support in terms of easier financial conditions, inexpensively priced markets, and light positioning. We think that means, on balance, modest gains for the equity markets in Asia, but with a lot of amplitude and noise around that. That's basically the world we're in.
How do the Hong Kong protests factor in here?
I live there, so obviously, I'm seeing it, right up close, and there were certainly way more than the 300,000 people that the government's official number suggested. I think who knows if it was 2 million or not, but it was definitely closer to the upper number than the lower number. I think with the outcome so far in terms of the bill being put on hold, which is probably just going to be allowed to die a quiet death if it's not fully rescinded.
Is that what you think?
That seems to be what the game plan is. Because technically, I understand that if it's not sort of re-energized, then it will die by next July, right? So the face-saving way to have that go away is just not talk about it and let it sort of die its own natural death. So that would preserve the current status quo in Hong Kong, which obviously is much better than what the concerns have been before. Now, in conversations with investors, there obviously is concern about this. Those have rescinded. I think one of the issues that many people have been focused on is what about the property market, because Hong Kong is a very asset-intensive area. The equity market is asset-intensive. Certainly for property, our sense is that things are actually still in a good way. The property market valuations are quite high, but number one, demand supply is tight, and number two, with the interest rates again falling and being at super low levels, it's very hard to make a negative case for property, particularly the investors who pay a very high dividend yield. So at least for the near term, we think things are on a pretty decent keel.
And what should I make just in terms of global growth? Back to your sort of macro picture here. I mean, we've got what 10-year German Funds, it's negative 30 basis points.
Minus 36 basis points as of last night. Yes, I mean, so global growth is clearly slow. Let me just get some numbers on the table. We have a monthly tracker of global growth we call our current activity indicator. It was just refreshed today. It's at 2.6%. The peak was November of 2017 at 5.1%. So it's significant slowing. Moreover, we have a leading global indicator, which has just fallen. It's now at 2.4%. So there's no doubt that we had a sort of a pickup in the first quarter, and things have rolled over in a coordinated way. In the U.S., our current activity indicator was 2.1% in the first quarter. It's now 0.8% for June. Okay, that may be a little bit overstated in the downside because of concerns in the Empire Manufacturing Survey regarding Mexican tariffs, which obviously didn't come into effect.
Right.
But the bottom line is that growth has been slowing. Europe is slowing. Japan's slowing. Japan is slowing. Sorry, China's slowing as well. So we need more stimulative monetary policy. I think that's clearly what we're getting. So that's kind of the uneasy tension that we've got overall.
What is the actual Chinese growth rate? How much is it slowing?
Okay, so we have on our monthly current activity indicator, which is obviously based upon more frequent data, we reckon things are growing at 5.5% currently. The target this year is for 6 to 6.5. I was just in Beijing with policy meetings just last week, so I'm pretty fresh on this. And certainly the feedback from those meetings is that China recognizes that they most likely will need to do more, either in terms of fiscal policy with stimulating infrastructure, prudent but accommodative monetary policy. That's their catchphrase. Probably some easing of macroprudential constraints, perhaps on property, and then being perhaps more flexible in the currency if the market demands that.